The second half of 2023 has been one of the most tricky times to be an investor. We've got the S&P continuing to fall after its mega 30% run from the cycle low. The Nasdaq also continues to fall after its mega run of 50% from the bear market low in October of 2022. And on the flip side, we have Bitcoin breaking out of a 7-month reaccumulation zone of 25 to 32,000, now sitting at 34,500. What is going on? In the back of this, we still have recession talks, recession fears. So in this video, I want to go through the S&P, the Nasdaq. I want to give you a broader scope of the US dollar and what I expect to happen over the next few years as we lead into these cycle peaks, which I've covered recently on a video with Annie on Crypto Banter. If you're new here, let me know in the comments section that you're over from Crypto Banter and the chat I did with Annie about the 18.6-year cycle. Otherwise, you regulars, you know the deal. Like and subscribe. It's your home of macro cycle analysis, studying the past to forecast the future, just the facts, the data, and the beloved cycles, which continue to play out time and time again. All right, guys, I want to start with a quick look at this particular cycle, as I want to dive into that just a little bit more, only looking at the US dollar and how that plays into this particular cycle, as it has done over the last 40 or so years, just to give you a little taster again, as there's quite a lot of you that came across some banter. So just to give you a little bit extra there. Now, all we see is recession talk after recession talk, 100% chance that we'll see a recession in 12 months and more recession talk. Now, before you jump into the comment section saying, look at the dates, that's exactly what I'm doing right now. This was 12 months and a week ago, okay? So the main thing here is that we always see talks of recession. We're supposed to have one in 2022, and yes, they changed the definition of a recession. 2 straight quarters of negative GDP growth is supposed to be a recession. They changed it. Okay, it's been changed. Maybe we got a technical one and we didn't get a new one. Maybe we get a new one next year, but it doesn't seem like it's happening in 2023. However, maybe the markets are pricing in a recession for 2024 with the instability in the market, with the instability over in the Middle East. Whatever it is, there is the possibility that they could be pricing in that now. So when the recession may or may not happen, or let's call it when it does happen, as a lot of people are expecting it, maybe it does. Maybe some of that pricing is already priced into the market. All we want to do is look at the facts and the data that we have now, not what the maybes might be in the future. Now, some people talk about the recession like it is guaranteed, as many of these articles have done, along with Bloomberg and some of the major banks, saying that this statistical model has 100% chance of tipping into recession within 12 months. Remember, this was 18th of October 2022, 5 days after the cycle low. So 5 days after the bear market cycle bottom. The bottom was the 13th. 5 days later, they said 100% chance of recession. We are 12 months on from that, 12 months in a week, no recession. Maybe they keep changing the definition. Whatever it is, the main thing we need to look at, and what I want to focus on today, is what is the chart telling us? Well, we got higher highs and higher lows. As simple as it is, that's what it's telling us. The market is essentially going up. And at the moment, on a broader picture, we're seeing a measured correction to the downside. We've seen a very big move to the upside after a bear market of 2022. And you have to have some time for the market to consolidate, digest the move, and then mount its attack to the upside again. All of this always happens on bad news. The first stages of a new bull market always and must happen on bad news. Why? Well, we just got a low in the market and it needs to climb out of that low. If we had all the good news, then we're pretty much at a cycle top. So when all that stuff starts to come out, and I suspect it will over the coming years as we look at the 18.6-year cycle, that is going to be warning signals for the top. The main thing is going to be stuff around this market can never go down. There's so much good in the market. You know, I'm doing a bit of speculation here, but we have to be prepared for what the media is probably going to throw our way, just like it did at the peaks in 2021, just like it did throughout 2019 into that peak of basically January, February of 2020. You had Trump saying that the economy's fixed and it's the strongest it's ever been. He did that at the top of the market. He didn't say that at the bottom of the market. He said it at almost the exact top, probably a few weeks out from that top. And then what do you know? Market collapses 30+% in a matter of weeks. The same thing happened previous, whenever those last peaks were. There's always something good going on for those major cycle peaks, like it happened in 2007. There was a lot of talk about property prices never coming down, and these markets are so strong that we're only going to see further upside. Of course, it couldn't be any further from the truth, but the main thing that we're seeing now is not all of this positive news like we saw at the peak in 2021, like we saw at the peak in 2019 into early 2020. We don't see that right now. All we see is the negatives. But what the charts are telling us is price go up, higher highs, higher lows. So I'm on record for saying these two particular lows are unlikely to break in this stage of the cycle. As we head up into this peak where we get the mania stage, it's very unlikely that we're going to see these two particular lows break. I don't always get the moves 100% right, but what I try and do is stay on the right side of the market as long as possible as we lead into peaks and obviously out of those lows. In this particular move to the downside, I have looked at the possibility of a single-digit decline. Now, we are very close to the edge of getting to a double-digit decline, so if and when that happens, you can remind me in the comment section that I was looking at a very high probability of a single-digit decline. 9.24%, I've got about 0.75% to go. That would lead us somewhere around 41, 45. So if the market breaks past that, by all means, tell me that we got a double-digit decline on the S&P. The other flip side to this is, even with that double-digit decline, we're still on the strong half of the 50% tool. There's the top, there's your 50%, so the halfway point, and there's the bottom, roughly 3,500 points. The problems will arise for the market if it breaks down from this, tests it, and starts to fade to come back and test these lows. So, just as a recap, I don't think these lows are going to break during this cycle of whatever price we head up to for the peak of the stock market. We're probably still, as I've pointed out in the last couple of videos, within that range of the market finding its low as we're putting in 1, 2, 3 moves to the downside, which is very similar to the bear market of 2022. 1, 2, 3 moves to the downside, except on a bigger time frame here with larger moves. So potentially we're just waiting to see where this market is finally going to bounce. Same sort of thing happened previously where we had the low in June and then the low in October. You can see the market went slightly under, took several days, bounced out of that. So we have that low here that happened end of September, early October, and now we have fresh prices today in late October. So we're going to see a similar sort of pattern, but on a smaller time frame, potentially. And of course, that's what I'd be looking out for if this thing is still going to put in that low, hold into the strong half, and start to move its way higher over the last half of Q4 of 2023. Call it November, December. I'll call it the last half of Q4 of 2023. So that's where we currently sit amidst all of the recession talks that happened 12 months ago, which didn't happen now. Maybe we get them in the next 12 months. The point is, just follow the chart. Don't worry about the news. The news is 99% of the time incorrect. It's wrong. And even if we do get the recession, what matters is you are trading the chart, not the recession. Just because we get the calls of a recession doesn't mean that that is the signal that the market then has to collapse. The market could be pricing in a recession for 2024 now, and by the time we get to the recession, maybe it's a small pullback and the market continues on its merry way within that same sort of period. So don't think that just because a recession comes and the market says we must get it in Q2 of 2024, that the markets all pause still, wait for that call, and then dump. It sounds pretty reasonable, but I guess most are sort of waiting for that period. Just follow the chart. As for the NASDAQ, it's in a stronger position, even though it is still coming down. We had 1 big move, 2 big moves, 3 big moves into that low, and then a higher low, and the markets over the coming months worked its way higher. You've got the receipts on the channel. You can go back. You know what to do here. Subscribe, like the content. Link in the top of the video description is for our free crypto and economic report if you aren't on that list already. And with that, there's also specials and discounts on TIA Premium. Anyway, back to the NASDAQ and looking at the receipts that I've been talking about on the channel. We were watching and waiting for a low to form at the bottom here, and it was a broken record at the time while everyone was telling me that the market had to collapse, and they were looking at prices breaking the COVID low. That is what the calls were back then through May, June, September, October, December, January. This was all saying that the market had to go back and break the COVID low. Completely wrong on that view, and they were waiting, which is pretty much what we've seen happen on Bitcoin as well. So I want to get to that in a moment in case you've missed out on this break and the whole preparation around that, what we can do next. And what we're seeing here, at least with the stock markets, is that they are continuing to go up, but for now, they are correcting after such a healthy move. So they had a big move, like we've been counting in terms of weeks, 40 weeks to the upside, roughly 41 weeks for the S&P and 40 weeks for the NASDAQ. 50% in price is 13,300, and in time is 20 weeks. 20 weeks takes us out to December. Do I think that's going to happen? Anything's possible. It doesn't have to wait for 20 weeks, but that's a target that I'm also looking out for. Now, we just broke those lows. We have another 4 days to go until the end of the month, and for the strong close for the NASDAQ is, of course, getting back above the previous bottoms here at 14,600. So you want to see a close above those levels closing out October. Otherwise, I think this thing is just going to drag on a little bit longer before we can start to climb our way higher. Remember, I'm looking for a bit more of a move in the second half of Q4 2023. Call it late November or December, of course. Again, the main thing is to not get too swept up in all of the bearish news because, like I've just pointed out, 12 months ago, they're expecting a recession. And the comment section you can see on those videos, while I was looking at this being the low forming, the transition period in the market, most were calling for lower prices, saying that it's foolish getting in now because this market is definitely going to come back and break past these lows. And the same thing was said for the S&P. There was calls for the market going below 2,000 points. Now it's 100% above those levels. That's a look at the technicals, the price, the support, resistance, the market structure, looking at the Gann swing indicator here as well. For the market sentiment, we're also seeing some higher lows forming at this stage in the market. We had very severe market fear coming in back in May and October of 2022. And now we're seeing price is higher. The fear is back at those levels. So one could say that it's potentially a good reset of the market sentiment at this stage. We still haven't got the uptick back above the green horizontal line here, but this is basically how some of these lows start. You can see that there's extreme fear. The fear subsides. It's not in the greed yet, but it's less fear, yet the prices went lower. So you're getting a divergence on the market sentiment compared to the price, which typically leads to a turnaround in that period. So this was a longer period, it just took a little bit longer. The same thing, if you remember on the channel when we're looking at the low for Bitcoin in June, happened in November. You had lower prices, but the market sentiment, the crypto fear and greed, was rising. So there wasn't as much fear on the FTX collapse in November 22 as there was when DeFi went down in June of 2022. So we had lower prices, but at the same time, we had higher fear and greed index reading. So there was less fear in the market. And with that turnaround, it took some time, but we ended up getting higher prices. And now the market's up over 120%. Just about patience. So if we can be patient, read those indicators on a broad macro view, then it sets ourselves up for much better decision making compared to what the news tells us at the lows, which is dated here 5 days after the exact low. What the banks say, they are telling us that there is a guaranteed recession in the next 12 months, yet the price of the markets went up from that point. So I did say I was going to show you something about the US dollar in the intro, and this is looking at it from a broader picture for the real estate cycle. So this is the real estate and economic cycle. It is not the stock market peaks and troughs. However, everything moves in unison, give or take a bit of time. So the stock market peaked in 2007, bottomed in 2009. The land or housing, real estate, and economic cycle bottomed around 2009 through to the first half of 2012. It's a much bigger cycle, and we're talking about the land market with hundreds of trillions of dollars and the economy. It just doesn't bottom like the stock market and rebound from that point. It takes time. It takes time to round over the top. It takes time to round over the bottom. So keep that in mind, especially as we lead into the next peak, which according to Akil, we're looking at roughly 2025 to 2026 for the land and economic cycle. That doesn't mean that the stock market can't keep going into 2027, but typically it is going to take some time, and we'll start to see some of those signals. So make sure you are subscribed to the channel, like the content so it comes through. Thanks to all you guys from Banter. Let me know in the comment section if you are coming across from that as well. So the US dollar, what typically happens in the second half, and I'll go through this in a little more detail in future videos, but not to give you too much at once because it can be a little bit overwhelming. The second half of the real estate cycle, we typically see the US dollar fall. So we saw it fall last time. We got a peak in 1985 into a low here of 1992. So remember, it wasn't the peak of the stock market, but the peak of the land cycle, and that bottomed around that early 90s. Most countries had a recession at that point, and land prices were quite low, Australia included. We had a pretty big one then, and land prices were quite low. You can see it bottoms into that period. That time frame to the low, roughly 7 years. Next cycle, top 2001. So it topped around 2000, 2001, 2002. You can see the top forming there into the exact low here for the US dollar, 7 years. Interesting? Cool, I'm interested. So that was 2008. The market also took roughly 10 years. Let me draw that better. 10 years at this low, 1987, before it started to break out in 1997. Happened again, 2004 into 2014, roughly 10 years around those lows. And now that price movement was pretty significant. It's 30% up. The previous time before that, 36% up. So just in that range, and if you want to measure it from the top, of course, it's going to be different. There's 26, and it was roughly 20% to the downside. So 7 years down, 10 years within that period, and then the market started to move up. So this is the US dollar rising. That's the first half of the real estate cycle. So it seems like we've seen that, and you can see this from pretty clearly from the chart that it's been rising. It rose last time 92 into that peak, 2000 to 2002, and again this low of 2008 with the real estate and economic cycle bottoming around this 2011, 2012. There's that little higher low, and then the market starts to take off from that point, coming to a peak roughly 2022. If this is to repeat, some pretty big stuff here. 7 years to the downside takes us to 2029. So I'm not expecting the US dollar to roll over and drop to these lower prices tomorrow. This is going to take some time, but this works in with the real estate cycle. And when the US dollar falls in this second half into that easy era of very easy money, we get the commodities booming, we get the stock markets booming, and that's pretty much what takes us there. And then obviously the US dollar continues to fall before the collapse and basically the flight to safety again for the US dollar. And through that first half, this section, that's where what we've seen in the past, at least for the last couple of cycles, over the last 40 plus years, remember, we've seen a rise in the US dollar for that period. Now, another interesting long-term macro point here is that we've seen lower highs form for the US dollar and lower lows. But maybe we're starting to see a little bit of a reversal here because the time to the upside was 9 years the first time, and from this low was 14. And if I want to measure it from the 2011 low, that was 11. So the time before that, I think it was 7. There it is. So 7, 9, somewhere between 11 and 14. So the time to the upside is getting a little longer. Maybe this is setting up to round the bottom, wherever that is in 2029, and then start to work its way higher and finally break that resistance. This is going to be a long way off. It's just a scenario, a theory that I have at this point. Maybe that's the final run for the US dollar. I don't know. It could be the opposite, and the market basically breaks down, gives us another lower low, which just shows the weakness to the US dollar, which lines up with all of the theories that people have now for BRICS taking over, or the Chinese yuan taking over, or maybe even Bitcoin taking over. Any of these are options. I think there's still probably a solid 10 to 20 years until we figure this out from the US dollar. But for now, it doesn't seem like the US dollar is going anywhere. It's still the world reserve currency, even though there is the possibility that this market rolls over again like it has done in each of the previous second half of the real estate cycle, which is what we are currently in. There's a possibility, no guarantees. I'm interested to see what happens over the next 10 to 20 years, especially for Bitcoin on the back of the real estate cycle as well. Like and subscribe. You've got a video popping up here on your left-hand side. Go and join me for that if you want to see more content like this. Otherwise, I'll see you back here at the next video. Links in the top of the video description for TIA Crypto, the free crypto and economic report there. Guys, thanks again. Till then, take care and peace out.